Alright, so to follow on the latest video for our daily structure, I want to talk a bit about fake traps, so fake SMC traps. I've basically explained that a little bit in the latest one, where I say that if we have a very clear POI, then most likely price will use that as a trap and will induce it, take liquidity from that point before moving towards our direction. So for that reason, let's talk about traps. So lately in the markets, there's been a lot of SMC traders coming in, ICT traders, which basically use the same concepts. They use supply demand, they use order blocks, entries like that, but they don't really understand the framework the market works in. They focus on the smaller time frames and on taking trades a day and refining everything, which in the long run isn't really profitable. Only a select number of people can trade the lower time frame successfully every single day. It just puts a lot of pressure on your mind. So for that reason, the market has adapted, the algorithm has adapted. Before, it was only inducing liquidity from retail traders that are using basically Fibonacci support resistance, basic knowledge. Now, because there's a lot of retail traders, basically SMC is the new retail, as a lot of people say, the market has adapted and now it uses a lot of fake traps, a lot of smart money traps. So a smart money trap can start from a fake change of character, does something like this, and instead of respecting it after a change of character, it liquidates the low, does a V shape, and then continues to the upside. And us as traders, we need to adapt every single day. We need to understand what changes, what doesn't change, and how liquidity is formed, so we can basically start trading better, right? So we don't take stupid trades. So that's an example of a smart money trap. Another smart money trap is a very clear POI that doesn't get respected. So here, for example, a lot of people would take trades from this high. They would take sells. And I know I've actually got a few messages of people asking me why the sells didn't work. So we had bearish market, right? Change of character to the downside, a huge impulse move, correction, and back to the last bullish candle before the bearish candle. So 50% of it, and usually people will just enter here, have a stop loss above, and then target the lows. And they get stepped out, and then they call trading a scam. But it was just a clear candle where people would take trades on, will take sells on, because again, people don't think, most of the traders, they don't think. You need to think in order to become a profitable trader. You need to understand, think outside the box. So if I'm looking at this setup for a potential sell, I'm wondering, why should I take sells here where it looks very nice for sells and a lot of people are selling? No, let me buy in that area because price will most likely push and take liquidity, and that's exactly what happened here. So you need to think outside the box. And also because, as I explained in the previous video, the framework was buys. Daily 4 hour was bullish, 1 hour looking at the higher time frame, 1 hour never gave any confirmation for sells. You see here it had a push, a break of structure, price retraced, failed to create a new low, ranged for a bit, and then started pushing towards a new high. So that was a very, very good example of buy, right? Just doing a few. So price never did any confirmation for the buys, right? So also if you use the Fibonacci, right, you came right at that sweet area for buys. So instead of selling here on the 50 minute, on the 5 minute, because you see some kind of confirmation, there was no confirmation on the 5 minute also. Price was just ranging, and most people, when they see this inside the order block, they sell. But there is just liquidity being built. It's attracting more money sellers into the market, and then it stops them out and continues to the upside. It's very easy once you focus on the higher time frames. And now, fake SMC traps are happening also when there's a point of entry, as I told you. It's very, very clear when you have, let's say you look for an entry, price gives you confirmation. So price comes into a demand zone, gives that change of character on the 50 minute, it comes down, and you start looking for buys inside that area on the 1 minute or the 5 minute. And inside the area, what can happen basically is price gives a reaction, gives a 1 minute charge, and then when it comes back to retest, a lot of traders, smart money traders, they enter with the stop loss covering that low. Very, very tight stop loss, 1 pip, 2 pip, 3 pips. I'll show you guys how we can enter on the seconds time frame using smaller pips also, which is something you need to know when you want to take really precise entries. Lately I haven't really traded the seconds, I just look for confirmation sometimes, but it's very nice to know. So they tend to get that really, really tight stop loss, which stops them up like 2-3 times before entering the profitable trade, the winning trade. And price, what it does, wicks them out, makes a V shape, and then quickly pushes to the upside. How many times did you see this happen to you? For me personally, I did. This happened to me a lot of times. So now I know how to basically manage it. So when that happens, there's two things I do. First of all, I enter the trade here, but I do a bigger stop loss. Even if it's Euro USD, it's perfectly fine. I do like a 10 pip stop loss in case it wicks down. And what I do is I add another entry when it wicks below. So when price is wicking below and I see a huge 1 minute candle, that's usually the signal here, because if it just ranges slowly, then most likely price will continue breaking down. But if it just either wicks it or just closes like a huge bearish candle, then usually what happens, comes right back up and goes on. So after I see that, I just enter another trade and then either have another 10 pip stop loss and then reduce it when price is rejecting, and basically either keep both entries or just close this entry when price reaches the break-even point and have the better entry, which gives the risk reward way earlier. That's how you can avoid traps like that. That's how I do it, and I found it very, very successful. Now that's about it with the fake traps. You need to trade, you need to spend some time analyzing the charts and looking for entries to see all the traps that the market does. Usually a trap like that happens during the times where there's volatility, so London Open or New York Open. That's when price is about to give the entry and you really see, you worked down the time frames and you really wait for the 1 minute, 5 minute, because you are in the beginning of the session and you wait for that entry. That's when price usually plays around a lot, stops you out, and then continues in your direction. So for that reason, again, you need to understand and really pay attention to traps when they happen. Something like this. So you see something like this, gives a choch, and then usually what happens, price wicks below, gives up, and then starts pushing. So you'll see that situation a lot. But here was a very clean trend. Also, when there's news, same thing happens. Here you had news, price came down, gave a nice break of structure, and then price came lower to correct the news before pushing up. So you need to have a lot of patience. But again, I can teach you everything, but you need to understand practice is what makes perfect. Here another example. So 1 minute had a nice impulse to the upside, and then when price is coming back, people and smart money traders, they execute here, they cover the low, and then they target like a 1 to 5, let's say, because you have a small stop loss, you only target 11 pips. Price gives a nice reaction, fails to break higher, comes back down again, plays around here. So usually if they go break even, they just re-enter again and then see what price did. Huge bearish candle and then popped up. So this is the moment you need to identify the trade and don't get stuck on the 1 minute time frame. Even here, you see how price liquidated the low, came right back up, and then gave the setup to buy. So you need to wait for liquidity to be taken. Here, there's been liquidity being built, price took liquidity, and then went out the way. So the most simple fix you can have is use a bigger stop loss. So even if you use a 8 pip stop loss, let's say, yes, your risk reward is going to get lower. You also need to target higher to get that risk reward in, but you just increase your win rate by a lot. And then eventually I would add another trade here after I see the rejection. This is a perfect example. I see the big bearish candle taking liquidity, price is switching bullish again. I just enter here covering the low because I know price is bullish, wants to move up. It just wicked below to take liquidity and it's now ready to move on. And this you can have a better risk reward and price moves your way. So it's that easy once you understand really how market moves. Even now you see how much price is ranging. Here it took liquidity down, then came back up, and now it's ranging again. So it's most likely waiting for New York to start pushing up again. But because it's outside volume area, price is just range. So we need to wait for volatility to come back in the next session to take that trade. But yeah, guys, the conclusion of this video is if something looks very clean to you, a POI or a setup, a 1 minute perfect change of character, retest, then most likely it's a trap and most likely it's just gathering liquidity. So the simple way to fix that is we use a bigger stop loss, cover a bit more, and when you see another break of structure, when you see confirmation prices moving your way, you can either reduce the stop loss or just go break. And that's how I manage the trades, and that's how I can keep a big and a high basically win rate. It's that easy. You don't need to trade the seconds all the time. You don't need to take 1 minute entries with 2 pip stop losses. That's nice for risk reward, but you're gonna take a lot of losses and a lot of break evens. So it's best to just take 1 to 2 trades a week with a bigger stop loss, focus on lower risk reward, and I'll show you how you can be profitable in the long term using that strategy, and you remove a lot of noise. But we're just building through the concepts, and at the end we're gonna put everything together and show you more examples of good trades that I take.